So this is the yield curve. It's the 10-year minus the 2-year. So you take the 10-year yield and you subtract the 2-year yield. And normally this number should be a positive number, which would put you above this yellow line here. This yellow line is 0. And so normally for 10 years, let's just make up a number. Let's say it's 3% interest rates for 10 years, which is actually a pretty good interest rate for 10 years. 3% interest rate for 10 years, and then let's say the 2 years maybe 1%. So you take 3 minus 1, you end up with positive 2, right? So positive 2 would be like right here somewhere. And anywhere basically above this yellow line is normal, because you should expect yields and the curve to price out like this, right? Because who in their right mind is going to charge you more money for 2 years than they are for 10 years, right? That's a little bit of a backwards situation. There's just so much more risk. That's the opportunity cost, risk, all kinds of things. So the longer out you go, from 10 to 20 to 30 years, the higher the interest rate should be. But look what's happening here. This is the 0 line, and we're trading way down here at -1. So basically what that's telling you is maybe the 10-year is at 3% and the 2-year is at 4%. Right? So you take 3 minus 4, you end up with -1, which is the exact value that we see on the screen here, right? Now, why is this a problem? Well, just try to think it through. Under what conditions would folks want more money for 2-year risk than they do for 10-year risk? And the answer is it's not a good sign, right? Basically, it's a sign that things under the hood are not working correctly. And you can see here, because of the boxes that we've drawn in, there's a couple of times in history where it has happened. It has happened there, happened here, it happened here, and it happened here, and it's happening here, right? So then ask yourself, well, if you're a market historian, you might remember 2000 and 2001. If you're a market historian, you might remember 2007, 2008. Some of you may remember what happened in 2020, and maybe even remember back here with that one, what happened back there in 89, 90. So the problem is not the inversion, right? The problem is not when it goes below 0. That is a precursor to the problem. Think of it like going below 0, like you start cheating on your diet, you start eating 100 hot dogs and 100 hamburgers every day, right? And then you have a heart attack and die. Now, what killed you? Was it the heart attack or was it the hamburgers and hot dogs? Well, it was the heart attack that killed you. But the precursor to the heart attack was the hot dogs and the hamburgers. So we're in the hot dog and the hamburger part of the phase here, if you will, right? The market's very indulgent on hamburgers and hot dogs here, but there's no heart attack yet. The heart attack for the markets historically, because again, every circled period, except this one so far, because we don't know what the catalyst will be here, has led to a significant and historical market crash. COVID crashed 35% in just a few months. 2007, 2008, that was a big crash. 2000, 2001, that was a big crash. 89, 90, that was a big crash. So the crashes happen when you get the rip out of inversion, right? Now, the question is, since the crashes happen when you get the rips out of inversion, do we have that yet? Has this ripped out of inversion? And the answer is no, right? Now, there becomes an interesting situation where the more you pull on the rubber band this way, the higher and faster it'll spring that way. But from a timing perspective, and this is the payoff at the end of the conversation, from a timing perspective, this isn't anywhere close to ready, right? If you want to see the potential effects that this can have on the market, this candle right here, this big white candle, the only giant white candle there in the series, that's March. Go back and check the monthly candle on March for the indices and see what that did. Now, they have managed to kind of suppress this, and you can see the next 3 months have been lower and lower and lower, and the markets have done what? Gone higher and higher and higher, with tech certainly just going crazy, right? So what's our signal? What's our tell for this? Well, The tell is when it gets back above, there's going to be 2 points of importance. One, when it gets above 0, and then historically, if you're looking for the absolute timing signal for, and I hate to say a crash, but it's exactly what it's setting up here. And again, I say crash, but it's not, don't the trigger, so you don't have to go and do any weird stuff in front of the trigger, right? I'll show you the trigger. The actual trigger for crashes is right about here. And you can go back and check my work on this. Take this chart, overlay it with the chart of the SPY. So it usually comes in at 0.5, the actual crash. Once it goes 0, that should get your red alert. At 0.5, you should be completely flat and out of the market, right? Okay, so that's basically the thought process behind it. So do you need to look at this chart every day? Absolutely not. This is months away from triggering, right? Very months away from triggering. But when it does trigger, it triggers extremely quickly. So that's the full song and dance on the yield curve. It is the ultimate signal that I know that there's huge problems under the surface. If you understand the mechanics of what we talked about, ask yourself, why would the smartest and biggest money in the market, which is the bond market, choose to price risk more highly on the front end than the back end? Why would they charge you more money for 2 years than for 10 years? Doesn't make sense, but it's a sign of severe stress in the system that's hiding under the surface. So just to put a cap on it, don't need to look at this chart every day. We'll talk about it as we need to. 0 is the first barrier, and then by the time it gets to 0.5, that's where the fireworks kick in. Okay. If this chart goes lower, the market will want to go higher. If this chart starts to move higher, that will put pressure on the market. The ultimate trigger, 0.5. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.